What in the world are adjusting entries? Hold the show. I thought we've been journalizing, posting to the ledger, and make a trial balance. What else does an accountant have to do? And the trial balance is just the beginning of the end. This is part of the end. So a business gets to its fiscal year end, which might be a calendar year end also, and they need to get all of their books updated so their financial statements are as accurate as possible. Adjusting entries is part of that process, and to define them, I've got a couple bullet points. It ensures that revenue is matching expenses. So whatever you made money on in that fiscal year, the expenses that got you there better be listed. They are not optional. They are necessary, because the trial balance, what you did in chapter 2, probably doesn't tell the whole story. In chapter 2, your trial balance said you had $1,000 of supplies. That was at the beginning. But have you used any of them? Yeah, you probably have. Have you used up some of your prepaid insurance you bought? Yeah, you probably have. So you have to tell that story and get it more up to date. It is required. Every time a company prepares financial statements, especially at fiscal end. And here is a lucky little trick to remember. Remember when I told you about you have to have a debit and a credit? Here's another trick. Every time you do an adjusting entry, one of the accounts has to come from the income statement, and the other one of the accounts has to come from the balance sheet. So not only are we debiting and crediting every time we do a transaction, when we do an adjusting entry, one of them is from the income statement and one of them is from the balance sheet. Let's revisit who belongs where. What two kinds of accounts are on the income statement? What's it called when we make money? What's it called when we spend money to pay for our revenue? Expenses. So when you do an adjusting entry, you're always going to have one either pulled from revenue or expenses. What are the kinds of balance sheet accounts? Assets, liabilities, and owner's equity. So let me paint this picture further. If we're doing an adjusting entry to see what we have, what we used in supplies, would supplies be debited or credited? Are we gaining them, or have we said we've lost some? We're crediting supplies because we bought some, but now we're seeing what's left. So supplies would be credited. We know that's from the balance sheet. We're going to learn about a new account called the supplies expense, which we know is from the income statement. And that's the adjusting entry to show what's gone from supplies or what's been used. To illustrate that further, I want to just draw some stuff, okay? Let's say at the beginning of the fiscal year, I buy 4 erasers. Those are beautiful erasers, okay? So those are supplies. At the time of purchase, we're going to debit them. We gained 4 erasers. The year goes by, fiscal year, calendar year, it doesn't matter. Year goes by, and it's December 31st, which happens to be both a calendar and fiscal year end. And someone's job is to run around and count how many erasers we have left. And they find that there's only 1.5 erasers left. 2.5 are gone because they were used. So we have to account for those 2.5 that are gone. So we are going to credit supplies for 2.5 because they're gone. And we're going to debit the supplies expense. for 2.5. Those 2.5 erasers are gone. We only have 1.5 left. We're not going to say that we have the 1.5 again. It's not like we're going to gain 1.5. It's just that we've lost those. They're gone. We used them because we use those expenses in order to gain revenue. We needed some erasers around. And I just made it erasers so they'd be easy to draw. Okay. Notice we've got a debit and a credit. Got the debit, got the credit. But we also have a balance sheet account and we also have an income statement account. What gets tricky about adjusting entries, and I don't want to put the cart before the horse because this is what I'm going to talk about next week, but sometimes they say, you use 2.5 of your erasers. Sometimes they tell you that. Or sometimes they say, after a physical count, you have 1.5 erasers left. So you either know the number or you have to go search for the number with some simple math. See how you do on this question. To all of them. We need to do adjusting entries so the expenses go with the period in which they occurred, the revenues go with the period that they occurred, and it allows us to do our financial statements most up to date. Because back here, if I would have said I had 4 erasers, that's not true because I used 2.5 of them. My real story is I have 1.5 left. That's what would really show up on the financial statements. I hope I hit record. Oh yeah, we're recording. Sorry, Mila. Okay. Find this in your notes. I hope it's there. Good. Good, good, good. You're going to hear some similar words. We heard that accrual basis accounting is what GAAP likes because you're recognizing things when they happen regardless of money being there or not. What you need to know are there are 4 types of adjusting entries that either are an accrual or a deferral type entry. What I want you to do before you plug in all of the fine print here, I want you to write these 2 notes that I left for you as I presented this PowerPoint. A deferral adjusting entry is when the money is there, the events are going to come later. So the money is on the table, the events will occur later. Those are any time money has been presented, later on the work will happen. So anytime you see the word prepaid, that means the money's here. Let's talk about the 2. Because you either are an adjusting entry is either dealing with expenses or revenue. So let's just focus on the deferral side. What are we deferring to happen at a later date? The event. Prepaid expenses. Expenses paid in cash before they're used or consumed. I didn't do this for my annual sale, but in the past I have. Sometimes I've prepaid. I still call it the Sun Tribune, Stevens County Times. Sometimes I've said, hey, run this ad for me. I'll give you the money now. Run it for me 2 weeks leading up to my sale. That was a prepaid expense. I haven't even made money yet, but I'm already spending money because I have to tell people to come to my sale. I didn't do that this year. I really pushed on social media instead, like a few of you noticed. I could even pay Instagram and Facebook to run ads for me. I didn't do that either. So prepaid expenses mean you've paid for it. Now the occurring or the event will happen over time. As that happens over time, you got to do an adjusting entry. So let's say I ran the ad for 2 weeks, Junk by Jenny sale, 5th annual. Woo, come and get it. Okay, I pay the newspaper a bunch of money. They run the ad for 1 week, and for whatever reason, my fiscal period ends before the next ad runs. I have to stop and adjust that some of that prepaid expense actually happened. The event, they ran an ad for 1 week even though it wasn't for both. depending on where the fiscal year ends. For me, the fiscal and calendar year ends at the same time. Unearned revenue. You have learned about this one. Cash received before services are performed. We know that that's a liability. What do we owe in this case? The service. If you pre-purchase tickets to the last weekend's Vikings game, now they've done the work. They had the event last weekend. But still, you as a customer bought that on the front end before the Vikings played. So these are both adjusting entries, because then as the Vikings game was played, the Vikings had to adjust that, hey, we fulfilled that obligation. We had our game. In both cases, I either paid for my ad or I paid for my Vikings tickets, and I waited for the event to occur later. It was deferred to another time. Now let's go to the other side. Let's talk about accrual adjusting entries. We're still talking revenue, we're still talking expenses. The event happens, and then later the money shows up. So accrued revenues. Revenues for services are performed, but we haven't yet received the money. Can you guys think of an example where you earn money and then later they pay you? AR. And as they pay their bill, especially when the time we're supposed to be getting our financial statements made, we better go make sure that those ARs have been paid or fulfilled. Accrued expenses are expenses incurred, but they haven't been paid yet. The lights are on here at school. It's actually not too bad. It's pretty warm in here. Are the events happening? Yeah, the lights are on and it's warm. The utility meter is running. The school's probably not going to pay the bill until the bill comes. So the events are happening. We're just waiting for the money to show up. When that bill is paid, we adjust for, yep, we paid the bill. I want to take the same concept, and I want you to notice something. I'm going to flip these around. Next, I'm going to talk about accruals first, and then I'll talk about deferrals. Do you have this in your notes? Page through toward the back. I think it's there somewhere. When you see the big dollar sign. I feel like it's in there. Okay, toward the back of your notes from me. Yep. Well, it's got the big dollar signs. Okay, so just notice accruals was on the right side here. It's on the left side. Oh, this time. I actually like this one better because this is the event without money. Here's the almighty dollar. This is the money without the event. Sometimes students like this visual better because it shows, okay, here's the event happening. Haven't got the money yet. So if you think of this as like a timeline, here's the event before we get paid. Here's the money on the table. The event will come later. So it's flipped from your other notes. It's just, I think it's kind of helpful. Remember, all of them deal with revenue and expenses. Money coming in, money going out. I just need you to know accrual, deferral, revenue, expenses, and examples of each. So everything's the same as what I just explained to you. It's just a timeline where the money occurs. And at the end of the fiscal period, when it's time to do our financial statements, we better update and see if ARs have paid, see if the Vikings had that home game, see if we paid the utility bill, see if the Sun Tribune truly ran the ad, because then it's been used up. And we have to update and get our balances a little bit more accurate. Not only are we going to have a debit and credit, but we're going to have something from the income statement, something from the balance sheet. We'll come back to this little thing again. I just wanted you to see it. Same concept, just a different layout and format. where would prepaid, like I buy supplies, and as I use them, where would that fall? I go buy those 4 erasers on January 1st, and on December 31st, I only have 1.5 left. I used 2.5. Where would it land? Ben, it looks like it's on the tip of your tongue. It's a prepaid expense. Because I went and bought all those supplies. So in other words, cash was on the table. So were the erasers. And as I literally erased my way through a year, now I don't have as much left. And I have to update supplies because I bought it. And now it's not worth as much anymore because I used it. Where would the pay for your crown and then go get the crown from the dentist later show up? So paid for it. Haven't got my crown yet. If I'm the dentist. Unearned revenue. Money was on the table. Customer, little Johnny paid for his crown. You, as a dentist, owe the work. A few of you look confused because I didn't say who are we yet? Are we the dentist or are we the customer? Okay. The lights are on at school. We haven't paid our bill yet, though. Which one is that? Accrued expense. The event is happening. Lights are on. When we pay our bill, we need to update that. You got it. It's got another video. It's another bad cartoon. Different characters today, though.
Hey guys, I hope you're doing well. Let's learn about accrual accounting.
Yes, let's. Sounds great.
Okay, so you're busy for an accounting major and you have decided to become a businessman. Julia was a tutoring service. You thought that these four professors didn't look like this job. You decided to show them how it is done and earn some money. When you thought about the business, it came to your mind that you will need a couple of things to get it running. You have decided that you will need to hire a tutor. You're a businessman, not a worker, remember? You also needed to supply paper and pencils to the tutor so he can explain well. Finally, you found 2 customers that are interested in your service. Let's say that you have brought 2 packages of paper and 2 pencils. You have to record these transactions right away. You give your accountant the receipt and you record it. He tells you have brought supplies, which is an asset, to remove every supply, you have 10 cash.
Is this at the beginning or the end? Is this happening at the beginning of the fiscal year or end of the fiscal year? Beginning. So your tutor that you've hired to help these accounting students has some has supplies to work with.
You have received the $60 cash. You gave this information to your accountant. The accountant tells you that since we have received cash, you have to debit it. But we did not earn revenue yet.
Tell me about the credit. Your tutor hasn't tutored. This girl is just waving this money at him. Okay.
Instead, we owe the girl tutoring for 1 month. So we credit unearned revenue, which is a liability.
Neither of those transactions were adjusting entries. Those were the transactions you did in Chapter 2. Transactions that were happening during the months in chronological order.
December 31st, we need to close our financial statements. We have provided account tutoring to the girl about half of the class. Your accountant tells you that we need to adjust the account.
Why? Why are we adjusting? Okay, we're adjusting when? On December 31st. End of the calendar year, end of the fiscal year. Cool. Why are we adjusting? Did you catch that? Have we tutored the girl a little bit? All of it or part of it? Part of it.
Now we have earned half of the unearned revenue. It means we do not owe the girl classes worth of $50 anymore. So we have to reduce the unearned revenue account.
So this liability that originally went up, I forget I can't write on those. Okay, so this liability of unearned, which normally has a credit balance with the plus, when the girl was waiving the money, it went there. We did some of our work, half of it actually. So you're going to subtract 50 and turn it into earned instead. I don't want to write on this, so I'll be very careful and write over here. Unearned revenue is a liability, so that's a balance sheet account. What does this one have to be? It's got to be income statement, and it's revenue. We have a debit, we have a credit, we have a balance sheet. The other one had to be income statement. So basically, we're turning that, we fulfilled half of our work. But on December 31st, we have to say that because it's got to be pertinent to that fiscal year before we close the books. So what they gave you, they used half. Half's gone. So we have to adjust because remember this is December 31st. Supplies. Don't worry. Was it 200? We initially bought 200 and they're saying at the end we've used half. So we have to adjust for what we used. I'll try to find it. This was your initial, this was your original transaction. What are they? Accruals or deferrals? Was the money there? No. Sorry, I was too slow. They're deferrals. The money was there. We were waiting for the events. The events in this case, using up the pens and pencils and paper and tutoring the girl. Now you're going to see it from the accrual side. Tell me about accruals. Is the event there or is the money there? The event, and then we're waiting for what? The money. I love that. We defer the use of it. So we buy it or we get paid for it and we defer the use of it. How much has the guy worked? About half? Have we paid him yet? So it's accruing. It's piling up what we owe him. Because we need to say, and let's say this is 2018, we need to say that salaries and wages expense happened. We didn't pay cash, rather we have a payable. We owe the employee. But we have to say in 2018, the guy earned 10 bucks. We haven't paid him yet. That's why I don't like wage expense. Typically it's salaries and wages expense.
have agreed. Let's see what our accountants have to say about this. We don't need an accounting entry when we agree to terms. However, on December 31st, we closed the financial statements and released the bank account. The total received through the services in the amount of $25. That means that we owe us. So we have an account.
Again, I'm not fast enough. But AR goes up. He didn't pay us cash. And we earn money. I don't like earned revenues. I just like revenue or service revenue. In all these cases, there's been no money exchange yet. It's the event that happens, but we have to adjust as it does.
Let's revise again. Imagine this is some kind of a timeline. The availability of timeline that we see the page. Remember perfectly that we have just discussed. We agreed with the teacher to pay this monthly, which means we are accruing or piling up wages expense. This is expense. We also agreed that the boy pays monthly. This means that we are accruing or earning each day during that month. Let's revise the entire lesson. We have accruals and deferrals. With deferrals, we pay or receive cash first, and then we defer or postpone the expense of the revenue. With accruals, it's simply true. We're working to free and hold the customer will pay. There we're using our employees for free until we pay them for free later. Thank you for watching. See you.
See you. So, awaiting on my website is your first of your e-learning practice round. You would have been doing these same things tomorrow, pen, paper, but because we have the capability to do this digitally, and our school would like us to practice a snow day, I've got them ready for you. If I'd bring you to my website, remember I'm talking about all of it down here, what's happening. The lecture that I'm recording right now will eventually go here. But I have, watch for any e-learning assignments. Here it is. I literally took the questions from the book that I would have had you do anyway, and you're just going to answer them here. I would suggest opening it in forms so you don't have to try to do it in this small space. If I understand forms correctly, you can't start and then it will save. Am I right or wrong? I don't think it will. Ben Gies suggested, go dump your answers into Google Docs, and then when you're ready to complete the full form, bring them back over here. So if I were you, I'd open it in forms so it just looks a little bit cleaner. Okay. If this were a real snow day, and I didn't alert you to bring your books home, keep in mind some good resources would be to re-watch my lectures. And you'd be able to get your answers from there. Your books are a lot more detailed. Your notes are a lot more detailed, but at least you'd have something to go by. So that ends the lesson. And next week, we're going to get into the intricacies of, we're going to start by talking about deferrals, what they look like, what accounts are impacted. Then we'll talk about accruals, then what they look like, what accounts are impacted. We'll do the actual, like here, if I show you just this one. In October, Pioneer Advertising earned $200 for advertising services that had not been recorded. So what would the entry look like? So we'll actually practice them. That's it for today.